I'm going to bring in Schwab Chief Investment Strategist Sonders right now, joining us with more. good to see you.
Hi, Maria. How are you?
Thank you so much for joining us. So what do you make of this big rally on the Trump victory?
Well, I think as certainly a lot of ink has been spilled, I think the idea is that particularly with the GOP sweep, that the focus on growth-generating type of policies would be good for the stock market. So I think also it reflects a lot of positioning heading into the election that was maybe a bit more cautious, and then the unwinding of some of that positioning. So I think at the outset, some of this rally was a bit of short covering by some of the higher frequency trading firms. So I'd be a little bit cautious in making the assumption that this is the path for the market out the medium term.
Harlan Hill here. So it seems to me, that in the long term, he is a great bet for the market, considering that he wants to, cut taxes and stimulate growth. In looking long term, how do you feel about the market's reaction to Trump?
So longer term, there's still a lot of unanswered questions, because obviously key on his platform was also anti-trade pro-tariff policies, which I think would be decidedly negative, not only for the U.S. economy, but for the global economy. Clearly on the regulatory and tax side, it's a positive, but I think you're going to start to hear from some of the deficit hawks as well. So even that piece of the positive, particularly if it comes with an infrastructure plan, comes with an increase in the deficit, which really didn't get a tremendous amount of attention during the election, because I think there has been bipartisan support for infrastructure spending. I think it makes a lot of sense. You need that economic growth to sort of justify that looking longer term. But I think we're going to see some of the deficit hawks step back in, because in conjunction with rising rates comes higher financing costs of this debt, that as we increase the deficit, that adds to the long-term debt, which is not a problem that's gone away.
Lizanne, it's Kevin Kelly here. I'm glad you brought up the financing costs going up, but I think also another impediment that may hurt is the stronger dollar. Do you see that as an impediment on the market going forward, especially on earnings into 2017?
It certainly could be if the strength persists here, because remember a year ago or so, when we were looking at a 25–30% year-over-year increase in the dollar, and commensurate with that, of course, was the crash in oil prices, it had a significant impact on corporate earnings. The energy piece was the biggest part of it, but certainly it hit the export side of our economy, which translated into weaker earnings for some of the industrial companies and basic materials companies. And I think that may be why you're seeing outperformance by small caps, which tend to have a bit more of that domestic bias to it. So the ideal environment for the dollar is actually stability, where you stay in some semblance of a trading range. So I think a persistent move, I think, would start to bring into question the loftier assumptions that are built in now to 2017 earnings growth estimates.
Lizanne, factoring in the Trump presidency, earnings where we are, the data that you've seen, do you want to put new money to work in the stock market right here or not?
So, Maria, as you know, we've had a neutral recommendation on U.S. equities, which means in Schwab parlance is telling our investors to stay at their normal long-term equity allocation. I actually think, given the strength that we are seeing, because we believe in tactically rebalancing around that norm, there's probably more money that may want to pare back, take advantage of this rally, take some profits in order to move their portfolios back in line. So it really depends on how the money is positioned relative to the long-term target. But I think this is probably an opportunity to book at least some profits.
And in terms of sectors, technology has not performed with the rest. I wonder if you want to look at the so-called Trump industries like energy, since he's going to tap into energy, like banks, since he wants to roll back Dodd-Frank. So what's your take in terms of sector allocation? Technology has not participated.
Right. So we do still have an outperform on technology, and I think that is being hurt by virtue of what the potential trade problems, as well as this being a very domestic orientation in terms of stock market leadership. Financials is the other sector on which we've had an outperform rating, so we're certainly still comfortable there. On the energy sector, we have a market perform rating. The two areas where we have had underperform ratings is in telecom and utilities. So we do still believe that those areas had gotten rich as investors were looking within the equity market to find yield, to find income generation. So we're still saying avoid those. But of that, financials and technology at the top of the list, clearly financials has been the better bet recently.
All right, Lizanne, good stuff. Thanks so much. We'll see you soon. Lizanne Sonders from Schwab.